tell me also if I'm pronouncing your name correctly. Is it, so it's Dr. Jomot? Or how do I say it?
Yes, perfect.
Jomot? Okay.
Jomot. It's good, yes.
Good. And I have your bio off the website, if that's sufficient, or is there something in addition that I should add?
Yeah.
Okay. All right.
No,
Great.
no, it's fine. It's fine.
Okay.
Thank you.
Good.
Actually, I'll text my colleague to let her know.
Okay. Just warning my children to be quiet.
Same here.
How old are your children?
I have one who is 13.
13. Okay, so I'm at 16 and 18. So
okay,
I don't know which. I think it's a toss-up as to which age is more likely to obey. I think neither really. So. Aha, there we are. Welcome, Som. So I'm going to virtually introduce Dr. Jomot to Professor Somnathan.
Very nice meeting you.
To Luis Breyer, who's the resident representative at the Delhi office of the IMF.
Navroz, do we go live now?
Yes, since we're all ready. Is everybody ready to go live? Should we just go ahead?
Sure.
Okay, why don't we go live? Sure. So Parth, I might give it a minute or so after we go live before I start, yeah?
Okay.
Yeah, but just going live in 3, 2, 1.
Thank you to those of you who've joined this event. We are just giving the rest of the people who signed up a minute or so to join, and then we will go live with this event. We will start the event. Okay, very good. I think we'll get started, and a few more people will join as we go. Good evening, good afternoon, good morning to all of you. Thank you for joining this event, co-hosted by the Center for Policy Research and the International Monetary Fund. My name is Navroz Dubash. I'm a professor at CPR, and we are hosting this event to discuss a very interesting paper by one of our colleagues who you'll hear from shortly from the IMF. And we've titled this discussion, Climate-Friendly Growth in a Post-Pandemic World. So this is, I think, the topicality of this particular issue really shouldn't need much explaining. So I'll just make a couple of very brief introductory remarks before I introduce the panelists. The context for the discussion today for this and the paper that we're going to look at is the challenge of mitigating climate change. in a world where we are also dealing with a global pandemic. And in this context, there's been a lot of conversation in policy circles about what governments can do, how they can do it better, how they can do it in ways that don't drag down the economy and impose costs on people. So we've had a lot of discussions here in India. We've had a recovery and rescue package, the Atmanirbhar package. We've had measures introduced in our budget just a couple of weeks ago. And despite the fact that we've done all these things, it is not like the time for that conversation is by any means over. I think what we are all learning is this is a longer term set of questions. How do we recover from a shock that's as severe as this pandemic has subjected us all to? And how do we use this perhaps even as an opportunity? The opportunity is a difficult word given the social cost this pandemic has wrought. But how do we use this as a moment, if you like, to repivot our economies, to think about how economies can be turned in the direction of greener economies, less carbon emitting economies, and economies that generally allow us to tread more lightly on the earth, which of course is also one of the reasons we've had this pandemic, is because of the costs we've imposed through environmental destruction at root. So this isn't a once and for all policy issue, it's an ongoing discussion. And so we felt it was appropriate and useful to open up this conversation and keep it going in a sense in India, hear what colleagues from the IMF have to say. And the sorts of questions they're asking are very salient, which is how does one think about stimulating an economy or putting in place long-term policies, or I should say, and putting in place long-term policies that shift economies in a more green direction? What do we know about what has worked and under what conditions? What do we know about the costs of these measures, if any, versus the benefits? And how do we mitigate some of these costs? How do we make sure that the vulnerable in societies don't bear the burden of this sort of adjustment? So to help us think about these questions, I'm really very, very pleased to welcome Dr. Florence Jomot, who is a Deputy Division Chief in the IMF's Research Department. She's worked in a number of different departments within the IMF and has experience in a number of country teams. Her work includes work on the labor market, on inequality, and on open economy macroeconomics. In the past, I think Dr. Jomot has also worked at the OECD and has a PhD in economics. So she's very well qualified to lead this discussion. In a minute, I'll turn it over to her to present a paper for about 20-25 minutes. And after that, I'm going to turn to Professor E. Somnathan, who's also here with us today, who's going to be the discussant for the talk today. So Som is also an economist, and in addition to teaching at various US universities, is currently at the ISI here in Delhi, where he's a professor in the planning unit. I should say that we're also very glad to have Som associated with us here at CPR as a visiting fellow, and we're delighted to have regular conversation with him. Som is also extremely well qualified to comment on this because he was one of the coordinating lead authors in the last IPCC for the chapter on national and subnational policies and institutions. The IPCC, of course, being the Intergovernmental Panel on Climate Change, though I shouldn't really presume that everybody will know that acronym. So Som is going to then kick off the discussion, after which I will turn it open for questions from all of you. We want to make this as discursive as possible. That's sort of our tradition and our preferred way of operating here at CPR. And then I'll request Louise Pryor, who's also on the call here, who's the resident representative in India for the IMF, to maybe say a couple of closing words at the end of the session. And we will aim to close promptly at 8 p.m. Indian Standard Time. So with that, let me hand it over to Dr. Jomot and ask her to please make her presentation. Feel free to share your slides.
Yes, good afternoon, everyone, and thank you very much to Mr. Dubash and to the CPR for the invitation to speak today. Let me share my screen. Okay. I'm here today to present you some of the highlights from a recent study we published in October in the IMF World Economic Outlook about mitigating climate change and how to design mitigation policies in a growth and a distributional friendly way. This report was done in collaboration with a big team of economists in the research department at the IMF, who are listed here in the front page. And if you want more information or more detail about the analysis, you can find the paper online. Some of you may wonder why the IMF is putting climate change at the center of its work. Well, the window for limiting temperature increases to safe levels is closing rapidly. And as the IMF Managing Director, Kristalina Georgieva, said recently, climate change represents a fundamental risk to economic and financial stability. Now, as you probably know, the average temperature over the surface of the Earth has increased by about 1 degree Celsius relative to levels in the pre-industrial era. And this is thought to be accelerating. Under unchanged policies, it could increase further by between 2 and 5 degrees Celsius by the end of this century. And this would impose growing physical and economic damage on the planet. Let me move a little bit, please. Can you see the full slide, or is it obstructed on the? It's good. Okay, thank you. Now, estimates of these damages vary, but the more recent estimates tend to show much larger damages than we initially thought, as you can see on the right-hand side. Just to give a bit of context, what are these damages that we are talking about? Well, these would include, for example, lower productivity from agricultural crop, fish farming, or also from people who have to work outside in hotter temperatures. They also include greater disruptions to economic activity and supply chains, and greater destruction of physical capital. So whether it's productive capital of firms, infrastructure buildings due to natural disasters that can become more frequent and severe, but also for coastal areas from rises in sea levels. Related to this, they imply a reallocation of an economy's resources toward reconstruction in the wake of disasters or flooding, and towards adaptation to try to mitigate the impacts of climate change. Another important damage is deterioration in health and possible loss of life in the wake of these natural disasters, but also because of a greater prevalence of infectious diseases as temperatures become higher. One recent study found that, if there was no further climate mitigation, by 2070, average temperatures could be above 29 degrees Celsius in about 20% of the Earth, as opposed to less than 1% today. And this would affect about 1/3 of the global population, putting great stress on this population and likely leading to important migration pressures. Last but not least, there is the risk of catastrophic outcomes, which could result from changes in Earth systems as temperatures keep increasing. And these damages are likely to be more severe for countries that initially are already experience hot temperatures. So the literature has found that these effects tend to be non-linear. Now, having said this, scientists have warned that temperature increases should be kept to below 2 degrees Celsius, and if possible, around 1.5 degrees Celsius to ensure safe levels, or at least avoid the most severe damages from climate change. This objective was endorsed worldwide at the 2015 Paris Agreement. And what this means in practice is that greenhouse gas emissions have to be brought to net zero by mid-century, by 2050, which is a very ambitious objective. Now, you could think that the current global recession that is associated or that was triggered by the pandemic would make it very difficult to take bold action on climate change, and it definitely makes things more complicated. But at the same time, it could present a unique moment to build back the economy better in a way that's more sustainable with long-term development. It does present an opportunity to green the recovery. On the one hand, the recovery stimulus can be designed to finance green and resilient public infrastructure. On the other hand, the policies can ensure that the composition of the recovery in private investment is consistent with decarbonization by providing correct price signals to investors and other financial incentives. Now, against this background, the analysis we did looked at two questions. How can we reach net zero carbon emissions by 2050 in a way that's growth, employment, and distributional friendly? Now, these three dimensions are always important, growth, employment, and income distribution, but they are especially important at the current juncture where many people are suffering from this crisis. And related to this, the second question is, can well-designed and sequenced mitigation policies help with the economic repair from the COVID-19 crisis? Now, let me give you a quick overview of the main findings of the paper, and then I will go a little bit more in detail into the findings. The first finding is that net zero emissions by 2050 remains feasible and would boost incomes in the long run and avoid catastrophic outcomes. A way to get there is an initial green investment push by the government combined with steadily rising carbon prices. We find that this would deliver the needed emissions reductions at reasonable output effects. And in the initial years, they would even boost GDP and employment. We find that the development of new green technologies, including through R&D support, tend to further reduce transitional output costs. While global effects are relatively small, there are large cross-country differences in output effects. And obviously, countries that are oil producers, for example, would be particularly affected, but also countries with fast population and economic growth whose energy needs will be growing substantially in the next 3 decades. However, these larger costs in some countries need to be weighted against the avoided damages from climate change, which will mostly occur in the second half of the century, but this is not so far from today. And what we called co-benefits from climate mitigation, which is additional benefits you get from mitigating climate change, such as reducing local air pollution and the health effects associated with that. Finally, it's important to make the transition to a low carbon economy as inclusive as possible. And we find that recycling carbon revenues can help compensate poor households and support job transition towards those low carbon sectors. Now, in the first part of the study, we look a little bit at the experience so far with what we can call climate or environmental policies. And we use an index from the OECD, the Environmental Policy Stringency Index. As you can see in the middle chart, these environmental policies have been tightened since the 1990s, so they have become more stringent. What we'll find in the study is that it contributed to increase both innovation and investment in clean energy. It did explain about 30% of the increase in lead to job losses in carbon-intensive activities. These are coal mining, shale oil and gas production, carbon-intensive manufacturing, and transport. In our analysis, looking at data from at the firm level from the World Scope database, we find that policies have broadly succeeded in reallocating jobs from high to low carbon sectors. So if you look, for example, all the way to the right on the chart, you can see the impact on employment in high emission firms and low emission firms. However, although the net effects on employment are not very large in general, there are large job transitions that can still involve costs for workers affected, and it will be important for the government to support as much as possible these job transitions. I will come back later to this. In the second half of our analysis, we tried to think about a policy package that would help us reach net zero emissions by mid-century, as I said before, in a growth, employment, and distributional friendly way. So broadly speaking, governments can use two types of tools, carbon pricing on the one hand and green supply policies on the other hand. By carbon pricing, we mean either having directly a carbon tax or setting up a carbon emissions trading scheme. Yet a different way to price carbon in a more implicit manner is to have regulations. Regulations impose a shadow price on carbon. By green supply policies, we mean policies that make the supply of low carbon energy more abundant and cheaper. And these types of policies include subsidies and price guarantees in low carbon energy sector. They can include direct public investment in low carbon infrastructure and technologies, or green R&D subsidies that support innovation in these new technologies. Our argument is that when you combine these two types of policies, carbon pricing and green supply, green supply support, you can actually deliver substantial declines in emissions without having a major hit to economic activity. Now, the policy package we look at in this study is a comprehensive policy package that has 4 legs. The first leg are these green supply policies, which include subsidy on renewables production, but especially a 10-year green public investment program. The second leg is carbon pricing. For simplicity of modeling, it's a carbon tax in the model, but as I mentioned before, there are different ways of pricing carbon. The important thing here is that the increase in the carbon tax is pre-announced and gradual, so it starts from very low levels and then goes up all the way to 2050. The third leg of the package is compensatory transfers to households. So about a quarter of the carbon tax revenues are used to protect the purchasing power of the poorest households. And finally, supportive macroeconomic policies. What do we mean by this? Is that basically initially and for the first decades, the package has some fiscal easing. So there is some debt financing, especially of the green public investment, but this occurs amid low for long interest rates in an environment of low inflation. Now we simulate the effects of this package using a global macroeconomic model, which is the G-cubed model from McKibben and Wilcoxon. And we also combine in the second part an integrated assessment model, which is stylized, but has the possibility of endogenous technological change. That is, we try to look at the response of technology to the policy incentives we put in place. Now, here is a snapshot of the results from the model. And the main takeaways, before I go a bit more in detail, is that the policy package actually boosts output and employment in the initial decade, supporting the recovery from the pandemic. And thereafter, the costs of the transition are moderate. On the left-hand side, you can see the effect of the package on global CO2 emissions. In red, you have baseline emissions that keep growing. You can see that both the green stimulus, so the public investment, and the carbon tax do contribute to reduce emissions. But a lot of the work is done by the carbon tax. One of the reasons for this is that, while both these types of measure change the relative price between high and low carbon activities, the carbon tax itself does tend to increase the cost of energy and therefore incentivizes energy efficiency throughout the economy. So one takeaway from this chart is that carbon taxes is really an essential component, or carbon pricing is an essential component of a very ambitious mitigation strategy. In the middle chart, you can see the impact on global output in deviation from what it would be if we hadn't changed, if we were not changing policies, what we call the baseline. You can see in green the effect of the green infrastructure and subsidy, and in blue the effect of the carbon pricing. As you can see, the green subsidy tends to boost economic activity, and this is for a couple of reasons. The first one is that, in the short term, because it's financed by debt, we actually add demand to the economy in a period where the economic activity is pretty depressed. So, you tend to have this Keynesian multiplier effect. And a second reason why the public investment tends to boost output is that it increases the productivity in the low carbon sectors. And it will attract more private investment into these sectors. On the other hand, the carbon tax does induce an increase in energy costs, as I said before, and that tends to have a negative impact on economic activity. On net, if you look at the red diamonds, you see that in the first, actually 15 years, output is above what it would have been, in the baseline by about 0.7%. Yes, by about 0.7% on average. But over time, as the carbon tax is further raised, the blue bars grow, and therefore, we go into small net output losses by the middle of the century of about 1% below what output would have been otherwise. Now, this needs to be put in perspective, and just to remember that between now and 2050, the world economy is expected to grow by about 120%. So we're talking about being 1%, below that, after all that growth of 120% has taken place. So it's a really modest difference in output. In addition, if you take into account those co-benefits from climate mitigation, which I mentioned before, which is reduced local air pollution and better health outcomes, less premature deaths from air pollution, and these are shown in the chart in gray, you can see that the net effect in the black dot is actually neutral for global output by mid-century. On the right-hand side, we make again the point that there is a lot of growth in the baseline that is expected over the next 30 years, and that the deviations that we are talking about are relatively small compared to the baseline growth. So we're not talking about large costs. Now, this package is rich in employment, especially in the initial years, with global employment higher by about 12 million jobs in each year over the first 7 years of the package. Now, this is because we have some fiscal stimulus initially in the package, but in addition, low carbon sectors tend to be more job intensive than high carbon sectors. We show some evidence of that on the right-hand side with job multipliers for different subsectors of the energy sector. And as you can see, solar panels, for example, and energy efficiency investments are very much a job intensive. Nevertheless, as I mentioned before, going back to the left-hand side, you can see that there is a large reallocation of about 2% of employment from the high carbon sectors to the low carbon sectors. And this can be costly for some of the workers involved, which makes government action important. Now, while global output costs are moderate, there are differences across countries. Countries that are oil or fossil fuel exporters like OPEC, Russia on the right-hand side are likely to suffer very much. For those countries, you need to look on the right-hand side scale. But also countries that are expected to grow fast, both from a population and economic front, will likely suffer somewhat larger costs. And here I highlight India. For India, you need to look on the left-hand side scale. The cost from the package for India are about a bit above 2% of GDP by 2050, relative to baseline. Again, it's relative to baseline. India is expected to grow very fast in the next 30 years. But once you take into account the co-benefits and the expected avoidance of severe damages from climate change in the second half of the century, this seems, acting on climate change seems like a rational choice. So let me say a little bit more about the numbers for India. So as I said, the blue bar shows the economic cost, but these remain moderate relative to baseline growth. For example, in our simulations, India's GDP is supposed to increase by 287% by 2050 relative to today's level. And with the simulation package, the growth would be 277% relative to 287%. Of course, this is just one possible simulations, but it shows that this wouldn't detract much from the expected growth. The country would enjoy substantial co-benefits from climate change. And these are estimated at close to 0.5% of GDP immediately, going to 1.5% of GDP by 2050 for India. Over time, the world economy greatly benefits from avoiding damages, and you can see this on the right-hand side. Output would be significantly higher than it would be in the baseline in the second half of the century, because we are avoiding severe damages from climate change if we take mitigation policies. For India, which is already a hot country, the net gains from climate change mitigation could be up to 60 to 80% of baseline GDP. There is a lot of uncertainty about the damages, but as I said before, recent estimates suggest that damages could be much larger than what we expected before. Let me say a few words about technology, because technology it's a bit of a black box and something that we feel we don't have much control over, but technology can play a crucial role to smooth the transition to a low carbon economy. What we find in our analysis is that when you allow technology to respond, when you take into account the response of technology to the policy incentives, you actually reduce the increase in the carbon tax that's needed to reach net zero emissions, and you reduce the output cost, the transitional output cost from this transition. There is a case to complement carbon pricing with R&D subsidies early on, because there are a number of market failures that prevent new technologies from arising. These include a path dependency of research, so the fact that established technologies tend to have an advantage, and this creates entry barriers for new technologies through, for example, economies of scale or sunk costs and network effects. There can also be difficulty in accessing financing because these are relatively long-term projects that are very uncertain. And of course, there is the typical argument of knowledge spillovers, which is that when one inventor comes up with an idea, this makes it easier for other inventors to further innovate. But the original inventor does not take that further benefit into account, and therefore tends to invest less than optimal in innovation. Now, the effects of technology take time to show up. As you see in the chart on the right-hand side, the blue line shows a reduced cost, but mostly 10 to 15 years down the road. So these 2 points that we draw from this. The first one, that means it's important to put these policy incentives, so carbon pricing and R&D subsidies in place early on, because they take time to have their effects for new technologies to be developed and to spread through the economy. The second thing is that, counting just on technology is probably not enough to generate the substantial and quick emissions reductions we need to make these or temperature targets reachable. Now, one last point I want to make about technology is that a good example of the role of technologies is in the electricity sector, where low carbon technologies already exist, such as the solar technologies, wind technologies, and are economically competitive. So these are a bit the low hanging fruits for the next decade, the decarbonization of the power sector. This brings me to my last point, or the last part of the analysis, which is looking at the distributional impacts of carbon pricing and how to build inclusion. Low-income households are likely to be more impacted in many countries because they spend a relatively larger share of their income on energy-intensive goods, and because they tend to be employed in low-skill occupations in carbon-intensive sectors. Now, in India, it's not necessarily the case that poor households spend a larger share of their income on energy-intensive goods, but even if they don't spend a larger share, an increase in the price of these goods will affect more people who have less income. So we still have to address this to avoid, poverty effects. If you see on the right-hand side, public opinions about support for the good news is that there are tools that governments can use to alleviate.
I'm afraid we seem to have some connection. Florence, we have a slight connection issue, I think, maybe at your end. So you just repeat the last sentence or two, please.
Yes, sure. Can you hear me now?
Yes.
Okay. The good news is that government have tools that they can use to alleviate the inequality and poverty effects. The first one is using part of the carbon revenues to give cash transfers, universal or targeted, to poor households. The second one is using some of the carbon revenues to spend on low carbon sectors, like, for example, through a green public investment program, and support transitions of jobs to those sectors. Now, what we do in the chapter is we use a model and try to look at the impact of these policy instruments. Unfortunately, I do not have results for India here. We looked at the United States and China in the analysis. As you can see, a $50 carbon tax does tend to reduce the consumption of the bottom 2 quintiles, both in the United States and in China relative to what it would be otherwise. But giving universal transfers in purple or targeted transfers to the bottom 2 quintiles actually results in most of the case in an increase in the consumption of the 40% of poorest households. So this is an instrument that can help alleviate poverty effects or even reduce inequality. Now, in what I show you here, we're using all of the revenues from the carbon tax to redistribute them. In fact, if the goal is just to protect the purchasing power of the poorest households, we find that spending between 1/6 and 1/4 of the carbon tax revenues in targeted transfers to the bottom 20%, so by which I mean the poorest 20% of the population, would be enough. The second tool, which is using some of these carbon tax revenues to spend on low carbon energy sectors, would not fully protect the purchasing power of the poorest households, but would tend to deliver better outcomes in terms of aggregate employment and a further reallocation of jobs from high to low carbon sectors. In practice, governments are likely to face pressures to both protect purchasing power of people who are poor and to support job transitions. And the carbon tax revenues can help achieve both, or progress towards both objectives. Let me now conclude briefly. The main takeaways are that net zero emissions by 2050 remains a feasible objective that would boost incomes in the long run and avoid catastrophic outcome. And again, this long run is not so far away. The significant benefits would be seen as early as the second half of this century. But the window is rapidly closing. The chapter tries to make the point that a comprehensive policy package is key. In particular, we look at a combination of a green investment push combined with pre-announced and steadily rising carbon pricing. This tends to deliver the needed emissions reduction at reasonable transitional output effects and even with stimulating output and employment in the first decade. The green fiscal stimulus is important to support output and employment in the short run and to help lower the costs of adjusting to higher carbon pricing. In turn, carbon pricing is important because they tend to discriminate better between different energy types and incentivize energy efficiency. Finally, a fair transition requires compensating the lower income households for higher carbon prices and supporting job transitions to low carbon sectors. I will stop here. Thank you very much.
Thank you so much, Dr. Jamot. It was a very clear presentation. For those of you who'd like to delve deeper into this, my colleague Parth has just, during the course of the talk, posted the link to the paper on the website, on the IMF website. I should also add that, as some of you have already done, please feel free to start putting your questions in the Q&A box, and we will pick them up after we've heard from Professor Somnathan. I just thought very briefly I would sort of flag a couple of things that maybe we can pick up in conversation before I turn to Som. I thought it was very interesting that we talked about a package of policies, so a set of things that complement each other, and that's the way in which increasingly conversations are going. I thought it was also very interesting that most of the work seemed to be done by carbon pricing rather than some of the other green sort of stimulus packages, which is interesting. And perhaps there is another literature that looks at transition somewhat differently as fostering technology. So that would be something to talk about. It was also intriguing that India was one of the countries that did face costs, albeit perhaps not on the same scale as the benefits. And that finally, the framing of this whole presentation is around aspirations for net zero and it's striking that it's become such a dominant framing, and maybe something else we can come back to. But I don't want to sort of take away from anything that Som's saying. These are just a few things that maybe we can pick up later. Let me turn it over to you, Som, for your sort of more detailed and thoughtful comments on the presentation. Please. Maybe about 10 minutes.
Yep. Okay. Thank you. Thank you, Navroz. Thank you for inviting me. And thank you, Dr. Shamot, for a very interesting and stimulating presentation. I thought that basically I agree completely with the basic approach and the basic framing and the broad outlines and contours of the policy package. I think that all of these things are pretty uncontroversial for people who are aware of the climate problem and who understand the complexity and diversity of emission sources, which are very difficult to deal with without comprehensive pricing. And also the one thing that, there's another thing which favors pricing, which is that it's sort of very easy to do compared to other policies in the sense that there are just a few fuels. If you tax coal, you tax oil, you tax gas, and you've got 90% of the job done. And it's pretty easy to tax those inputs. Governments already tax them. It's just a question of taxing them at higher rates, or in some cases, governments subsidize them. And it's a case of basically gradually converting those subsidies into taxes. So, and you can basically address all the emission sources. So I'd like to emphasize something which is, I guess, sort of very obvious to economists, but it's not at all obvious to non-economists about the advantages of using taxes. And that is basically, it's just really this fact that climate change, the energy sector is really, the climate change is driven primarily by the energy sector, and the energy sector is a huge part of the economy. So if you want to address something which is a huge part of the economy, it's very difficult to do it on a sector by sector basis. So, you know, if you regulate power plants and say, well, you can't emit more than so much carbon dioxide, then the coal that the power plants would have burnt will then go to brick kilns and various other industries. And so emissions will balloon somewhere else. And then while you're chasing those emissions, somebody will invent something new, which will use coal or oil more efficiently. And those emissions will balloon again. And so it's the fact that that basically emission sources are so diverse, and there will be new emission sources coming along in the future with technological change, that if you don't use prices, you really are, you know, fighting with one hand tied behind your back. So that's, I guess, my, you know, in a broad sense, I really endorse the whole approach. I also think that the point that you made about gradually rising taxes is a very important one, because you need to give economies time to adjust. And particularly when you're talking about low income and lower middle income countries like India compared to countries like Europe and the United States, high income countries, low income country economies tend to be riddled with more distortions to begin with. And so it's, there is, in some sense, in some sense that makes the problem easier, because, you know, if you relieve some of these distortions, you can improve the environment and you can generate economic growth. And there are examples which are sort of quite easy to think of. Congestion is one of them. Right. So if you have spent any time in India, you know that practically every mode of transport is congested. Now, that's because you know, there are congestion externalities and they've not been dealt with domestic policy. That's an area where if you deal with the congestion externalities, you can get more growth and you can get lower emissions. That is if you deal with them appropriately. So that's the good part, that you can do that. But before I go on, I wanted to emphasize one thing in your presentation, which you mentioned, but I felt that you didn't emphasize it enough, which is that when one looks at the climate problem, the point is that 20 or 30 years down the line, we can have huge, huge damages from climate change. And they can be highly nonlinear, they can be cascading, they can sort of lead, one thing can lead to another. We can get all kinds of catastrophes, and most importantly, we can get political and social breakdowns, which can cause enormous damage. So climate change is really a hugely dangerous monster. And it has been sort of showing some of that already in a small way, but it's still in a small way. There's much worse to come. On the other hand, when we implement a policy package like the one suggested in the presentation and the paper, you do have some economic costs, but they're really modest. I mean, I think that's the thing that needs to be emphasized. You're talking about 2 or 3% of GDP, in 30 years' time. But in 30 years' time, GDP, as you pointed out, will have grown probably by at least 100%, maybe 200 or 300%. So, what is 2 or 3%? It's just a rounding error. Nobody will even notice it, and nobody will even know, once we get there. So the gains from doing something are sort of huge, right? The enormous benefits to doing this and the costs of doing it are very low when you add them all up over time. Problem is, of course, that right now, those costs are going to fall on very particular people concentrated in very particular sectors. And those people don't want to bear those costs. And that's really why we have, situations where we have so much coal, we have such a huge coal-fired power sector, which is so inefficient, right? Even though renewables are much cheaper, right? The reason for that is that a lot of people have a lot of money invested in those assets, right? And they're going to lose that money if the government follows any policy other than what it is doing, which is a sort of all of the above policy. We'll have renewables and we'll have coal. Of course, this is not realistic. You can't really have both. It's not going to work. So one or the other is going to have to give because electricity demand is not going to grow that much. But there's the political problem to solve. A similar thing is going on in the transport sector. The auto industry in India has been resisting technological change forever, right? And lately, very recently, they've been losing a few of those battles, and the government has sort of moved towards doing something about technological upgradation and fuel economy standards and so on. But really, it's solving those distributional and political problems which are difficult. And I want to emphasize that it's not really a matter of protecting the poor. That's part of the issue, but it's the bigger issue. It's a question of how do you deal with the rich. It's the extremely wealthy people who own assets in the automobile sector and the oil, in the coal sector in India, not so much in the oil sector, only partly. But really, those are the difficult problems to be solved. I also wanted to say that, again, there are, because the economy is so distorted, there are really huge gains to be got locally from dealing with some of these issues. So coal is extremely polluting, and it causes enormous damage to health and also to labor productivity. So it's basically it's a drag on GDP. So dealing with these problems will help us even in the short run, right, as a whole. But the question is, how do we get around these distributional and political issues? That's been a difficult problem to solve, and it's going to remain so, but hopefully there will be more urgency about trying to solve it. So I think I'll stop there. Well, maybe I should say one or two things. There are a few sectors, for example, like, solar power has been growing very fast, but it's utility scale solar that's been growing in India. And it's not very employment intensive. So there a policy push to sort of, to grow the distributed solar sector would be politically kind of attractive, I think, to the government because it generates a lot of jobs. So there are some policies over there which I think which are sort of which will move us in the right direction and which are sort of politically attractive and feasible. So I think more thought on those lines will help. But thank you very much.
Wonderful. Thanks so much, Som, for your comments. We have started seeing, and also for adding several Indian examples, which I think are very helpful, and I'm sure our audience will pick up on. I'm going to turn to the questions, but before I do that, I just want to actually raise one question for both of you to comment on. I have several, but I'll restrict myself to one, which is about carbon pricing. Now, the political prospects for carbon pricing are arguably not that high in India. I think the backdoor route that Som mentioned, where you have various fossil fuel taxes of various sorts on coal, gas, and so on, is much more likely. But I really want to probe this idea that if we don't get the prices right, we are missing the single biggest solution here. And both of you are, of course, professional economists. I'm not. So I look at it slightly differently. And I have a question here. If you look at all the literature that's come out post-COVID on stimulus packages, there's a wide array of measures that have been proposed other than prices. And there's been a lot of enthusiasm about the ability of various measures to shift economies, even if it doesn't include a carbon price. Also, if you look at the last few years, arguably the single most influential policy has probably been feed-in tariffs for renewables. And it's not really clear that a carbon tax would have brought about the decline in renewable energy prices that the feed-in tariffs and essentially the subsidy route has. So I find the graph that basically shows somewhat 60-70% of the work is being done by the carbon price. That strikes me as curious, given all the literature that's emerged on social technical transitions and how you can actually sort of move technologies up the adoption curve and down the cost curve. So I'd welcome one set of commentary on that, and then I'll open it up. Maybe you can start with Dr. Chumad.
Thank you very much, for your reaction to this. I must say, when we started the study, we wanted to find that you could just rely on green supply policies, of which feed-in tariffs would be a key example. So we wanted to find that, or just green R&D subsidies would do the job. But to maintain temperature increases to 1.5 to 2 degrees Celsius, you really need to start reducing emissions very rapidly and very significantly. And at least in the models we're using, we couldn't do the job just with reasonable green supply policies. We wouldn't get enough emissions reductions without any pricing in there. And I think it's a result that other people have found before. There have been studies by Valentina Bossetti and others in around 2010, looking at can we just do it with R&D subsidies, to get the new technologies, would that work? And the conclusion, their conclusion is the same. So you could always think it's a fault of the models. Maybe we're not capturing some important mechanisms. I think what at least the model that we and other people are using are showing is that carbon taxes are just, or some form of carbon pricing is just very efficient to reduce emissions. And one of the channel is because it does tend to increase the cost of energy and therefore incentivizes energy efficiency. When you try to reduce the price of green energy, you still get a reallocation of your resources from the high carbon to the low carbon sectors, but you do not act on the overall energy consumption. Indeed, you do not reduce it. You don't have that energy efficiency channel so much at working towards the emissions reductions. Now, it could be that, suddenly we get, brand new technologies very rapidly, and that we are able to do, the transition without carbon pricing. But would you want to bet on this? I mean, it's, this is something that's very uncertain, when technologies will become available and at what cost. And, I simplified a bit the presentation of the objective, but if we want to get to keep temperature increases to 1.5 degrees Celsius, we need not only go to net zero emission by 2050, but what matters is how quickly we get there, because what matters for temperature increases is the stock of cumulative emissions in the atmosphere, and not just the flow of emissions. So if we were to stay at high emissions for a long time and then suddenly reduce them by mid-century, that wouldn't be enough to keep temperature increases at safe levels. So we have to have substantial reductions now.
Okay.
Maybe one more point is that there are different ways of pricing carbon. So some countries are going the regulation route, and that's an indirect way of pricing carbon. It's basically telling you, okay, by a certain date, you cannot use carbon anymore. So there's an infinite price on carbon. And the US seems to be heading that way. But as Dr. Son said before, the advantage of carbon pricing is that all agents, with one instrument, you can incentivize the behavior of all the agents in the economy. With regulations, these are typically sector specific, so you need a lot of different regulations, and that can be difficult from an implementation perspective.
Right. Okay, Som, did you have a quick addition to this before we turn to the questions from the floor?
Yeah, sure. I mean, I think you're absolutely right that these deployment subsidies are crucial. In fact, Dr. Chaumont mentioned R&D subsidies, but I think that in addition to R&D subsidies, the deployment subsidies are also extremely important. And I completely agree with you that that's been very important, and it should continue. And those kinds of things are needed for new technologies in India, for example, electric vehicles, battery storage, hydrogen, and so on. Those need to be pushed forward, because now you don't need them for the solar and wind anymore. They're already competitive. But the point is that these, along with taxes, are complementary, right? The government has taken a lot of flack in India for what I believe is a really good policy that it's adopted, which is to keep petrol and diesel prices high, right? Despite them falling, price of oil falling in the world market, right? And they've done that by raising taxes. So this has been a really good policy. I don't think it was adopted for environmental reasons, let alone climate reasons, but it's been a very good policy. And if it weren't for that policy, it would be very, things would be much worse. We would have a much older vehicle fleet. Because remember, when the price of diesel goes up and you're a trucking company, you're going to turn over your fleet faster, because it's going to raise, you're going to lose money on those extremely old trucks. But if the price of diesel were 30% lower, then you wouldn't. So these things make a big difference. And there are opportunities to do this. The government has shown us how with petroleum. Maybe they'll be able to do it with coal as well.
Okay, thank you. We have about 25 minutes to half an hour for questions from the floor. So I'm going to actually start with a couple of questions around net zero emissions. We have one very pointed question that says, will net zero emissions then mean degrowth in some economies in the short to medium term, and then increasing incomes after 2050? And just as an aside, I note in the paper that you and your colleagues argue that it isn't really, there's not much headroom to differentiate between commitments across countries, with the possible exception of the fossil fuel suppliers you're giving a little leeway to. So maybe talking about what net zero emissions means for across countries would be interesting for the audience.
Yes, I mean, it's a very good question. We don't see negative growth in any country in the short term. As I was trying to show in the presentation, the impact on growth are really small compared to what is in the baseline. So there is no major decline in growth. The only region that obviously would be extremely affected are the oil producers, but they would be affected even if they don't do anything, domestically, just from the fact that other countries would be acting on climate because the demand for the main export products is declining. If anything, I think in the short run, a comprehensive policy package, combining first, trying to support the economy in a green way and then progressively raising taxes would be beneficial to growth and employment. And in the long run, green growth is the only growth we can get, because if we don't do anything, we're likely to experience degrowth in the second half of the century. So that would be my answer to this.
Okay. Did you want to come in on this, Som? Or maybe I'll just move to the next batch of questions, which is on employment. So a lot of participants had a set of questions on the job creation arguments in the paper, and I'm just going to sort of summarize 2 or 3 questions together here on this. So one question is whether you consider different technology scenarios when looking at job creation. In other words, the assumption about how many jobs will get created in new green sectors, and the fact that the new green energy sectors tend to be more capital and technology intensive. What does that imply now and in the future for the scenarios? A second related question is whether there'll be geographic dispersion on where jobs will be lost and where jobs will be created, both across countries, which is how the questioner has put it, but also within countries. And then the third related question is whether these numbers are global averages. And of course, there may be differences at the national level. The example given was on Indian coal, which is less productive than coal overseas, for example. So those are sort of a cluster of questions around employment. And again, maybe Florence can go first and then so.
Sure, I'm happy to. So on the different technological scenarios, the model, is the one that looks at the different technologies is not extremely granular. So I would say, we didn't really do many different technological scenarios. And, it would be important to further delve into this issue. But I would say that the fact that low carbon sectors are more job intensive than high carbon sectors, I think is an empirical regularity, and it extends beyond the energy sector. So other low carbon sectors, for example, are services. So what we see in the model is that you get some reallocation also from manufacturing, which is more high carbon intensive, to services, which is more low carbon intensive. So the energy sector, employs a good number of people, but it's still a relatively small share. The employment in the economy, and the adjustments extend beyond, that sector. In terms of job losses and their concentration or differences across regions, in terms of country differences, the countries that suffer more job reallocations and on net job losses are those that are big fossil fuel producers. So, that would include, of course, the oil producers, but for example, in the US, also because they have a significant fossil fuel sectors, there is more reallocation than in some other countries. And, models are always a bit over optimistic on how easily the reallocation goes between sectors. So although the net effect, seems small, you could think that there would be a transition period where it would be a bit more difficult, and how much government can support those transition could make a big difference. Within country, that's a very good point. Some of these industries are concentrated in certain regions, and you could expect that some regions would be more hit than the rest of the country, and that could be a justification to have what we called place-based policies, where the government designs a plan to support a particular region that would be particularly affected by the policies, say a coal mining region, or a region with oil drilling. So that may require an industrial policy to help the region adjust. I think you're muted.
Yeah, sorry. Yes, thank you so much. So would you like to add to this question?
Yeah, I mean, I think that in India, the sector that's going to decline, and that's going to cause a lot of job losses, and concentrated job losses will be the coal sector, and particularly coal mining, which is concentrated in eastern and central India, and employs a lot of people. Unfortunately, so I think that what really does need to be done is the government needs to get realistic about what's going to happen to coal. So even if they don't follow all these good policy recommendations from economists, the coal sector is going to decline anyway. And it's going to decline anyway because just renewables are already cheap and they're getting cheaper. And there's just no way that private investors are going to go into coal anymore in India. Okay. So if you look at, for example, if you look at Adani Industries, right, which is one of the biggest groups in India, right? What's happened is that a huge share of the value of the company just 6 or 7 years ago was in fossil fuels. And now almost half of the value of the company is in Adani Green Energy. The reason for that shift in the valuation of those assets is because the market can see that there isn't any future in the coal assets. And the market can see is that there's a huge future in the renewable assets. And that's just because there's been massive technological change helped along by government policy, which you pointed out, right? So the fact is that the government is burying its head in the sand, right? The coal sector in India is going to decline. A lot of people are going to lose their jobs. This is going to be an awful train wreck, right? And it's better now to take that coal cess, put some money into a fund, and basically accumulate it so that you can pay people off, basically give them 1 or 2 years of unemployment insurance and give them time to find new jobs. Unfortunately, there's no incentive to do that. There's no incentive to admit at this point that this train wreck is coming, right? So I'm afraid that the political incentives are to kick the can down the road. But it's important that people keep saying that, look, this is coming, this is coming, this is coming. You have to do something about it.
I think that's a very, very pertinent point. And just as an aside, we at CPR have been organizing a couple of workshops around this, and we'll be putting out some workshop reports, trying to get a conversation going, because it is a longer term conversation. And that actually bridges very nicely to the next set of questions, which is really about the just transition kind of narrative, which has emerged globally, beginning to take seed in India, about the fact that there will be losers from this transition, and they shouldn't be left to fend for themselves in a sense. So 2 questions. One is that the COP21 mentioned just transition, and that the fact that poor communities dependent on coal and thermal plants and so on, they may suffer the cost of transition more. And the question was directly about what the IMF, if anything, is thinking of doing about this. So in your conversations with countries, is there the concrete sort of package of suggestions for sort of inducing or stimulating countries to think about safeguarding these communities? It's the first question. And the second question is really about incentives for countries. So the question is that if you look at the redistribution of carbon taxes on the graphs you showed, there's a tension between spending the revenue of R&D an industrial policy for low carbon growth, and protecting the poorest. But in a world of global competition, where there's going to be competition around green technologies, is it possible or even likely that the incentive to fund R&D to stimulate your own green industries will crowd out use of this money for a just transition? So what's the political economy? How likely is it, in fact, that your 1/4, 1/3, or whatever the share is, will actually go to preserve the poorest when the time actually comes to make that decision?
Yeah, I mean, at the IMF, we just starting to ramp up our work on climate change. This was, not a core area of what we were doing before, but that there has been really a sea change, I would say, in the last year and a half, and in tandem with, the greater momentum, I think, that we see worldwide. And as I mentioned at the beginning, the reason why the IMF is now, clearly going into this area is because we see it's an economic and humanitarian catastrophe waiting to happen, and we think that this is really macro critical, for the world and for our member countries. And as the IMF works with the ministers of finance and central bank governors of about every country in the world, we are one of their counterparts. And as such, because many of the policies that are involved are macroeconomic policies, fiscal policies, monetary policies, we think we are, well placed to try to make some recommendations and push some of the policies that could be useful. Another change in the IMF, but the longer dating, is we've come to realize that we have to go beyond macro effects and look at inequality, and that we have expanded our mandate in this area and have spent actually quite a lot of our time trying to look at the determinants of inequality and policies that can address those. So my answer is at the junction of these two, big change trends in the IMF, we think that the distributional dimension and alleviating poverty effects is very important. And our managing director has clearly said and repeated on various occasions that the transition has to be made as fair and as inclusive as possible. And it's not only a moral imperative, for the people who might be losing from this transition. It's also a political economy, of political economy importance, because not addressing the negative effects that could impact some people could actually derail, the support for mitigating climate change and saving the planet from grid. So I think the IMF will be making recommendations to its member countries on addressing these inequality effects. In 2019, there was a publication by our Fiscal Affairs Department in Fiscal Money that tried to measure the inequality impact for a larger number of countries than we did. So if there is interest in looking at this, that's a good reference, and they looked at a number of policies that can be used to mitigate those effects. On how to use the revenues from carbon pricing, I mean, it's a political decision, and I think the best call is to use them, for a mix of objectives. Definitely addressing the poverty effects are extremely important, as I just said, and it can be done, in a relatively cost-effective way, especially if the cash transfers are get to those who need them the most. And then that frees some resources to, invest in the technology and other areas that government is interested
in. Okay. Som, can I invite you in on this question about the political economy of distributing these revenues and how that might shake out?
Yeah, I mean, it's a sort of thing that's very particular to each particular case, each particular industry, each particular, setup. It's just something that has to be resolved through the political process. And the resolutions tend to be better if you can have all the different stakeholders negotiate about this. And unfortunately in India, I think that one of the things that's missing in our polity is we really don't have a union voice. We don't have a labor voice. It's become very weak. It was stronger earlier, I would say, but it's now very weak. So if you look at how Germany is handling this, they basically got the unions and the industry and the green NGOs and the politicians all together. And they sort of had talks going on for a long time. And what that meant is it allows an exchange of information. It finally makes it clear to the union leaders, like, look, this is coming, right? Policy or no policy, this is coming. There's just no way to avoid it. So the question is how to get the best deal you can. And, that's really what we need for a lot of these things. I mean, this transition is going to happen. It can happen painfully and chaotically, or it can happen smoothly and nicely. But to happen smoothly and nicely, you have to start planning ahead. You have to bring people together and you have to bargain. Unfortunately, I don't think that we have the political organizations, in particular, I think with regard to labor, to help that happen very smoothly. I think that it's not only labor though, because it's also capital, right? We have a huge and toxic mess in the power supply sector, in the coal sector in particular, right? Because we had this big building boom between 2005 and 2015 in which we overbuilt all these power plants. And now half of the coal-fired power sector is underwater, right? And that's a problem that will have to be addressed. Okay, again, that's going to need resolution. And there was supposed to be a law which is supposed to do this, the Insolvency and Bankruptcy Code, and the government has but the government and the judiciary together have undermined their own law. Okay, so this is not good news at the moment, but hopefully they will realize that, look, that's the way to go. They should go back to the IBC and they need to resolve the problem, because the longer they let it fester, the worse things will get.
So what's coming out from some of these comments, and just going back to the question of how likely is it that some of the revenues will be used for the poorest is, obviously the answer at the first level is it depends. And it seems to depend in part on national traditions. I think, Germany's corporatist approach is a long-standing kind of accepted norm of bringing all these parties together, which we don't have here in India. And certainly, I think there is a risk that tax revenues, a substantial share of them, will not be used for compensating. This is sort of the classic kind of economist story, right? About where losers could theoretically be compensated, but unfortunately the politics get in the way, and they may not, in fact, be compensated. So I think it is a question to ask. I think the just transition narrative is an important one, but we shouldn't be sanguine about it. I'll just also mention in passing, I think it's fascinating that the IMF is foregrounding in its communication questions of equity, questions of just transition. It's also noteworthy, I think, that your managing director used to manage the environment and social, I think, the ESSD department of the World Bank. So she comes out of this tradition, which I think is quite heartening. So it's intriguing in the sense it's hopeful to hear the IMF foregrounding these issues in their analysis. We have time for maybe one more quick question, and then maybe we wrap up and also ask Luis to say a few words. Just quickly glancing at my list here. Actually, I'm going to come back, if you don't mind, to the larger net zero question to close this. I am struck by the fact that the formulation of net zero says that if you're going to reach net zero, every country in a sense has to head towards net zero. Now, just earlier this week, we had a launch in India of the IEA's India study, where they said that according to their most ambitious scenario, they call it their sustainable development scenario, India would at best reach net zero by somewhere between 2060 and 2070. All the other scenarios had India reaching net zero much later. So in addition to fossil fuel economies, so one of the factors that you talk about as a possible differentiating factor is dependence on fossil fuel revenues. But countries that are starting at a very low level of economic development, low incomes, and that have, and low energy use, I think it's really an open question as to whether they will be able to commit to and deliver on a net zero target without sacrificing development. At least it's something to be discussed a bit more. So I sort of put that to you, and I'm curious about your reaction.
Yeah. Okay, I guess first disclaimer is that, because we were looking at quite complex modeling, and for many countries, we had to take some simplifying, stylized, assumptions. So, just to make it manageable, for the study we were doing, we assumed that every country or every region was going to net zero emissions by 2050. And I emphasize the net. So that means there are still emissions. It's just we assume that some of the remaining emissions are being absorbed either by new technologies like carbon capture and storage, or an expansion of carbon sinks, natural carbon sinks like forests. But it doesn't mean that there are no carbon emissions at all anymore. In practice, you could have, some countries or some regions going there faster, and going closer to the absolute zero, than other countries, maybe countries at which are on the lower income side. So there's room for some, kind of differentiation within countries. When it comes to the development, the development needs of lower income countries, I want to make 2 points. The first one is that, because India, like other developing countries, emerging countries, still have a lot of infrastructure to build. This is also an advantage. If you build green from the start, you're building sustainable from the start. When you start with all your infrastructure already installed, and now you have to change it to something green, you have to scrap, all these assets. You have the problem of stranded assets, which is much bigger scale than when you're in the process of expanding infrastructure. So that could be an advantage, especially if governments are really want to take action on this. Making the right choices today might make this development much more sustainable. The second point I want to make is that we recognize that for countries that are emerging and developing, there is a need for some support from the international community, both financially and through technology transfers. Because these countries, still have a significant part of their population which is poor, and addressing this and increasing living is very important. So I think this is something we want to look more into in our next study, which is this international kind of burden sharing questions. I don't think we should, hold back on any action until these questions are resolved, because there is no time. And climate change and climate mitigation is what we call a global public goods, and it's very difficult for countries to coordinate this. But I think there is really a case to be made that that some support is definitely warranted, and we plan to to investigate this in future work.
Great, thank you. We're almost out of time, so maybe I'll just take a minute or two to offer a couple of strands, and then ask Luis to thank our panelists and offer his remarks. So, from an Indian lens, thinking about how we move down the road of both redirecting our economy and stimulating it, one of the things that I've really got from this talk is this idea of very deliberately constructing a package. So a package that makes sure that growth doesn't suffer in the short run, aligns incentives in the medium and long run, compensates losers, thinking about how all these things work together. And I don't think we do that quite enough in India, whether it's at the macroeconomic level or even at the sectoral level. My own observation, building on what Som said, is I think in terms of the pricing part of it, yes, pricing has to be part of the story, but I think for a while yet, it's going to be about smuggling in prices and thinking about pricing reform around fuels and so on and so forth, and basically the implicit carbon price that is embedded in some of these other pricing policies is my guess. We should be thinking a little bit more about that in the short term. I was very struck by Som's point about how we talk about these issues, and I'm convinced that we will have losers from a low carbon transition unless we get much better at managing the politics, at having those who are poorer and more vulnerable better represented in political decision processes, and taking a page from countries perhaps that have done a better job at that. So that conversation within countries, I think, is going to be really important. And those of us active in India are already starting about coal transition, and I think that's very heartening, and that we should put a lot more energy into that. And finally, the conversation across countries, so net zero, not net zero. I think that conversation that we've had for 20 odd years in climate negotiations about burden sharing and who does what, it's not like that has gone away. The problem has got urgent enough that everybody has to act, but it may not be the case that everybody has to bear an equal share of the burden. There are compensation mechanisms, as you said, Dr. Shamot, and delighted that part of what you're going to turn to next is thinking about the climate finance story and under what conditions and under what sets of rules maybe some of those transfers can help alleviate the burdens, because the burden at the end of the day is not going to be equally held across all countries. So I think this is a lot to take forward in conversation. Please do take a look at the paper. Thank you both very much. And now I'm going to hand it to, and thank you very much to all the audience members who sent lots of questions and have stayed through this conversation for the last hour and a half. So thank you all very much late into the evening here in India. So Luis, over to you for the last word.
Thank you very much, Navroz, for a very interesting conversation on the intersection of economic policies and climate change policies. And special thanks to Center for Policy Research and to Navroz in particular for allowing us to join this very important conversation in India and to learn from it as much as to contribute with our own research. And in that sense, Professor Somanathan's comments were very, very well received. As Florence mentioned, at the fund, there's a bit of a paradigm shift that has been going on for a few years now, but it has accelerated. And I think we will notice a push at the global level, including in those multilateral negotiations after a few years of not much progress and maybe some backsliding. So we hope to contribute to this conversation and appreciate this opportunity, Navroz, and I hope that we can continue in touch and do these types of events to share each other's thinking to see if we can, to some extent, make a positive contribution to this conversation in India. Again, thank you very much to Florence for a very good presentation, and I hope you all stay safe.
Thank you very much.
Thank you all.
Thank you so much.
Thank you all.